and welcome to the private sector engagement part one of the Good Food Finance Week. And thank you for participating in this third Good Food Finance Week. In today's session, this panel will discuss the stock taking of private finance commitments since the UN Food Systems Dialogue convened in February 2021, and look forward to the work that it will happen this year as we move to COP28 in the UAE. But more importantly, we'll talk about the challenges and opportunities that we are now facing in the deploying of private sector capital in support of the food systems transformation. We all recognize, and we wouldn't have convened here today and continued these dialogues if there wasn't a shared understanding of the need for multi-sector capital to support the equitable and sustainable transformation of the food system, the transformation for our environment, for human health, as well as for the financial return of an equitable and reasonable and robust financial return to all of the actors across the food system, from the farmers to those investors that support this transformation. For those of you who tuned in to the opening session of this Good Food Finance Week, you heard the President of the General Assembly deliver a very somber and challenging message to all of us, recognizing that despite the SDGs and the commitment of the global community to achieving the goals of the SDGs by 2030 and the confirmation of that commitment in the food system space with the UN Food Systems Summit in 2021, that instead of moving forward, we're falling behind. That the food system continues to detrimentally impact both our environmental health, our human health, and continues to have significant impact on farmer returns, as well as on the returns of and support for those returns from national governments, and the effect that national government financial challenges have had on their limited ability to invest. We all know the numbers. We know that $1.3 trillion is necessary as an annual investment required each year between now and 2030 to achieve a just and sustainable transformation of the food system. We also know that from a private sector standpoint, in 2022, we saw a decline in the amount of capital, private sector capital, that was invested in the food systems transformation, that we saw over a 40%, in fact, decline of private sector capital invested in the food systems transformation. One bright spot in those numbers is that in Africa, we actually saw an increase in the amount of private sector capital that went into food systems businesses. But the reality is, it's still less than $1 billion. And so it's significantly less than what is necessary to support the transformation that we need to ensure the progress that is required for us to achieve our ambitious goals of transforming the food system. But we are here today with a panel of experts, not just experts about finance, but experts from the community of interest for private sector investment in food systems transformation. We have a very diverse, but very competent panel that is not only competent in what they do, but as advocates for the work that is required for us to move forward. So we will, our plan for this morning is a panel discussion that would then be followed by Q&A, because we need your thoughts and ideas and questions about, and as well as your concerns about the investment of private sector capital in the transformation of the food system. And so what we need you to do is to use the chat box to jot down your questions or comments. And before we end today's conversation, with enough time to include as many of you as possible, we will go to that chat box and take those questions and comments, and our panel will thoughtfully respond to the concerns or questions that you post. So join us. This is not just a dialogue of those who are on the screen, but you as well. So join us in the conversation. So let's go right to our illustrious panel. Let me begin by introducing those who have joined us today. First, we have Sanjeev Krishnan. Sanjeev is the Chief Investment Officer and Senior Managing Director at S2G Ventures. And Sanjeev also serves as a member of the Builders Vision leadership team. For those of you who don't know, S2G is the largest food and agriculture venture capital investment firm in the United States, and growing in their investment and their partnerships across the globe. We also have Agnes Johan. Agnes leads the blended finance team at Rabobank's Rabo Partnership, which focuses on positive impact, creating environmental and social transactions, particularly in emerging countries. I should say only in emerging countries is where Agnes works. We have Mark Kahn. Mark is a co-founder and managing partner at Omnivore Venture Capital. Omnivore Capital is an impact venture capital firm based in India, which funds entrepreneurs building the future of agriculture food systems. And last, but of course not least, is Mark Watson. Mark serves as the president and co-founder of Pot Liquor Capital, an integrated capital fund dedicated to supporting U.S. BIPOC farmers at the intersection of racial and climate justice. And Mark has a long history in other areas of finance related to food and agriculture. So let's just go right in and begin with you, Sanjeev. Let's talk about a stock taking of private sector investment. I've talked about the challenges that we saw in 2022, and now in 2023, if you read the news with all the geopolitical challenges, it doesn't seem as if it's getting better. Is the private sector delivering on the commitments that have been made to support the transformation in the food system? Or are we going backwards? And if I won't let you just talk about the negative, and I'm going to come to each of you with this same question to start our conversation. Where do you see as the opportunities for increasing private sector engagement?
Thanks, Eartha. Thanks for having me. I think, we have to set it in context of the broad.
Sanjeev, we've lost you. Okay, why don't we go to you first, Mark, with the same question while Sanjeev repairs his system. Mark.
Sure, just fire the same question to me because you said it to him, and that assumes more about my short-term memory than probably it's late at night here. So
no, what I said was noting the sobering account that was given.
Are we going backwards?
Are we going backwards? And
look,
how do we stop and change and move forward?
So what I would say is it depends where on the capital stack you play, the perspective on that, and probably depends quite a bit by region. If I were to take India as an emerging market and therefore a place where capital honestly has been a little more available the last few years because of the bullishness on the Indian market. I don't think we're necessarily representative of anything, neither neither the West nor necessarily sub-Saharan Africa, but maybe somewhere in between. 2022 was a bit of a step backwards. If I actually just kind of crunch the data that we track in a partnership with AgFunder, about what the high water mark for farm tech investment in India was 2021. No surprise, $1.3 billion in the subcontinent. It dropped to 1.1. My reaction is, okay, could have been worse. Even in 2022, with winter upon us, right, there was still a north of $1 billion a year, being deployed to innovations in agriculture and food systems in India. How do I think that's playing out in other geographies? Probably worse, to be honest. India still has 6-7% annual growth and a lot of domestic capital, and is still a top 3 venture ecosystem. I imagine I know in Southeast Asia, for example, that 2022 was a bigger step backwards than in India. From what I've heard anecdotally from venture capitalists who operate in Africa, it was a bigger step backwards. But I think everywhere we're just seeing the impact. It's really not the war the war in Ukraine has done crazy things to food prices and fertilizer and other parts of our agribusiness ecosystem. But this is just about tighter money, right? We all forget that we had an incredible bull run with basically free money in 2020 and 2021 that plowed itself into literally every asset class imaginable, from NFTs, remember those, to all of the folks on this panel who were beneficiaries of it. And now we're dealing with a world where the interest rates of my childhood have returned, not quite at that bad a level, but where capital has a real price. And so I want to be cautious that we don't over panic, right? Because I think, even in an environment of somewhat tighter money, there is still incredibly strong secular interest in agriculture and food systems investments, especially given the adjacency to the whole climate thesis. Climate is probably the only space that continues to see, significant gains in investment year on year. And since we're sort of, basking in that glow or adjacent enough to it to benefit, I think we'll probably be okay. But certainly, like a little bit in India and a lot elsewhere, there has been a step backwards.
So, Sanjeev, we're going to try you again.
Okay.
Mark
Can you hear me
has
now?
Yes, we can.
Okay.
I'm sorry for answering your question, Sanjeev. I just had to.
No. I want to start off with that same level setting question from each one of you. So, Sanjeev, you just heard Mark talk about it depends, the step backward depends on where you are in the capital stack and where you are geographically. And that's still seeing significant opportunity, particularly in the climate space related to agriculture. How do you see it?
Yeah, I think it's bifurcated, I would argue, sort of what Mark was arguing. One, I think the pure financial players, the venture funds, the private equity funds, even banks, potentially are pulling back on innovation capital, the things that lose money. They're funding more things that are safer, more mature. That always happens in a bear market like this. I think that is natural. What's heartening is I don't think the strategics, the corporates, have pulled back as much. They seem to continue to be interested in innovation, using this as an opportunity to maybe even gain share in terms of innovating. I think where I do find kind of more universal, maybe it's a Western mentality, is a bit of a skepticism overall about some of the 2021 trends, even the 2020 trends, and in terms of just, where's the scale, where's the impact, and so we have this notion, is it dark or darkest before the dawn? And depending on it's really company by company, category by category, I think a lot of food transformation was often initially, because I think of some of the exit success and liquidity success, protein transformation. I think it's a food system transformation much bigger than protein. Protein is obviously a critical aspect of transitioning the food system. The other thing to also, I think we do ourselves a disservice if we don't acquire some of the capital that's reserved for climate. I think because of the IRA, energy and mobility have taken the oxygen in the room on climate. But we're trying to say, because I've started to do energy, we started to do other sectors, that it's all one transition. There's not a nature-based transition and a industrial energy transition. That's all interrelated in one. I think that will help hopefully attract more flow of capital. I'm optimistic in the sense that it's when things are tough that you find that the wheat from the chaff separate. And certainly like the last 12 to 18 months have not been fun. But I also think that this is when companies get made. This is when, product market fit occurs. And this is when innovation hopefully finds. The internet didn't go away in 01, 02. Consumer mobile internet didn't go away in 08, 09, and cloud didn't go away 08, 09. So I think, I've never been more excited about the biology, the physics, the chemistry, and the computation of using that innovation to help farmers and consumers globally. So I'm actually, continue to be quite an optimist.
Love that optimistic tone and appreciate the difference that you have made between the protein reduction in investment and the agriculture system, particularly in biologicals and digitals that are continuing. We're continuing to see opportunities, particularly related to climate money that may be available. But Mark, Mark Watson, I'd like to come over to you because your fund is focused on supporting BIPOC farmers and small farmers, those who are historically the last to receive private sector capital. So your perspective on this question of from whence we've come over the last year and where we're going would be quite interesting to our audience, not just from the US, but internationally, I believe. So can you tell us your thoughts on what's the challenges of 2022 and how we move forward in a more positive way for achieving this transformation that is so required?
Bertrand, thank you for the question. I'm going to tag onto the optimism that Sanjeev sort of indicated. And I say that because if you look in the US, BIPOC farmers and women are just 4% of the producers. And the days of darkness have been decades, if not centuries, for those farmers. Only now is their capital now flowing and realizing the connection. And I'd like to argue that the corral of money is not just food and food tech and agriculture. It's healthcare, it's education, it's housing. And I went to University of Chicago and I love my school, but we cannot be reductionists in terms of impact definition. And so one of the exciting things I see is that we're starting to see organizations like the GEN and big foundations like Windrock, who are global climate players, putting money behind different ways to measure resiliency and setting the context for the world we're trying to realize, which means re-educating market rate money. Market rate money tends to move in very specific, focused pathways, when in reality, we have huge barriers in terms of equipment that's necessary for regenerative farming. The impact investment community is 1.2 trillion globally. No, that's not enough money to change this, but it is money to de-risk and make a pathway for other dollars to sit on top of it. We have government policy, and I can speak to the US, where there are attempts now to invite softer, more patient, more holistic capital to buttress some of these transformational dollars that need to be spent. So I am optimistic for that reason. And lastly, public policy, and in this case, I'm talking about communities themselves, whether in India or Chicago, want to be in on this game. They want to move their own dollars into local, regenerative, flexible, resilient communities. and there are institutions now willing to entertain that participation.
So you're an optimist. You see us moving in the right direction, and so
I will lose my job otherwise.
None of us can wake up in the morning if we're not optimists in this space. The question is whether we're idiots, not whether we're optimists.
Exactly.
So, Johan, Agnes, let me come to you because you and your work have been referred to several times by the other members of the panel, specifically that institutional investors did not pull back in 2022. Commercial investors, I should say, like yourself, did not pull back in 2022 as part of Rabobank Partners. And is that true or not? I think our audience would like to know. The question on blended capital, as you are part of Rabobank Partnerships, how has the blended capital played a role in and you're continuing to support the investments as a commercial lender and investor, and how do you see the role of the blended capital in the solution to the challenges that we have seen in the reduction in capital?
So let me first straighten this out. I'm also an optimist, but it goes way, way slower than we had all hoped, I guess. And that I think, slower than it needs to go, because we are running out of time, basically, right? So thank you very much for inviting me on the panel. Rabobank, just for the people who don't know, it's a very big Dutch bank, but we have a focus on the food and agri sector specifically. So anywhere outside of the Netherlands, we only finance the food and agricultural sector. So over the last years, when we had the COVID and then the Ukraine crisis, of course, it's had a big impact on our portfolio of clients all over the world. But we didn't pull out. But what we did see, and here comes my blended finance focus, so more on the emerging market things, is that whenever there's a crisis for our clients, whether they're corporates or whether they're farmers, it has a direct effect on their focus areas, right? So if things are smoothing out and running fine, you can focus on the nice to have projects, like the sustainability projects, or you have a bit more thinking space to develop complicated new investments. Rather, when you're in a crisis and your working capital goes up and down and you have no clue what the logistical costs are going to be for your container, it's your scope of focus is becoming more narrow, and you focus just on the core of your business. And in my part, where I focus on developing blended finance products with our clients, we noted that that took a lot of their bandwidth, basically. So that also slowed down a number of these projects and transactions. There's a few positives that came out of that Ukraine crisis. For example, because the fertilizer prices were so high, we actually see that a lot of our farmer clients are speeding up the transitions towards, say, a biological fertilizer, right? And getting that ecosystem in place, making sure you get local inputs from there. I think, for one, it's a positive one. The same for, say, the high precision farming. Right, and it's a business case, right? Because the prices are so high, it makes it worthwhile to invest in the high precision farming and become very efficient in your resources. I think that's a win-win, and those kind of investments are for us still very interesting to finance also. But it's a win-win on both sides, right? And I forgot your second questions. Do we commit? No, we continue to commit, but it's also a strategic investment for Rabo, right? We have such a big exposure on the food and agri space. And I think it's the lack of scale that worries us most. The slow movement. And then I'm involved in blended finance. So, for example, we set up our own blended finance vehicle. Well, it's not our own. We set it up and we place it outside of the bank. So it's available for all commercial banks. It's called AGI3. And I think it's slow on the side where you find the assets, but it's also very slow on getting public money in.
Mm.
I'm extremely appreciative that the Jeff has become an investor in AG3, but it took them more than 3 years.
Hmm.
So if that availability of unlocking the capital takes so long also,
Mhm.
yeah, it's very hard for commercial banks to think now of programs to run with your clients if you're not sure when the money comes in.
Mhm.
There's a huge gap. And I think that's also where we need to bridge the understanding maybe between private banks in my case, but I guess
Mhm.
maybe also on my panel members here,
Mhm.
and the speed of which public money moves.
Mhm. Mhm. Mhm.
Yeah.
So thank you very much for the very thoughtful comments, and Mark Kahn, let me come back over to you with something that Agnes who said that was it's also spoken to by Mark Watson in his comments when we're talking about tools, specifically blended finance tools. Are the tools too slow coming online? Are we still at a place where, and why? What do you see as the challenges for bringing new financial tools online that can scale up the amount of investments, and if they're available, then what are the hurdles and challenges that we need to overcome as private sector investors to either accelerate the progress or to increase the access to new tools and new capital?
So look, you're talking to someone who plays who likes to joke that I deal in a world of innovation with very, 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 very basic products, where the innovation comes from the people that we back, but our products are, a very old tool called venture capital that's been around since, after the war, and we're still using more or less the same tool from that time period, right? Do I think there has been substantial progress on blended finance in the Indian ecosystem? Yes. But for the most part, that blended finance is linked to debt instruments, which is not what I'm in the business of dealing in, right? Should a venture capitalist have access to a more full stack, more full capital stack offering for our customers, for the people that we work with? It's funny, I say customers and I think, immediately about the startups. The truth is my customers, my investors. But given the way that we operate, we still think of the startups as ultimately our client. Do we think we should have access to disperse that kind of capital that's more sophisticated and more nuanced? Sure, but that's not really how the ecosystem sees it, right? Generally speaking, you have equity people and debt people, and never the twain shall meet. You have early people, you have growth people. Those are two different vehicles, except for I know to some extent Sanjeev has access to both. So we're all sort of in our respective lanes, and as a result, what we can offer to an innovator is by definition limited. But I do see the rise of players in my ecosystem that are able to bring more creative offerings to the table. Largely, they are venture debt players that have also become non-banking financial companies that are able to bring a variety of debt instruments to play to take some of the pressure off of the equity that a startup raises, and not just kind of vanilla venture debt, but for example, entire solutions around receivables, even factoring for startups. And so, whatever can reduce the burden on the equity side of things goes a really long way. I remember when I started doing this, we always used to say, listen, if capital markets work properly, you'd be using debt for your working capital and debt for your fixed assets, and only financing J-curve losses with venture capital. The reality with equity capital, the reality in the Indian ecosystem is you wind up early stage using equity capital for everything. And so I think the extent to which a more sophisticated solution for innovators can come forward, and I do see pieces of that, but more from the debt houses, the better.
So, Sanjeev, you were referred to several times in Mark's answer as having some of the tools that others may not on this call, and having some
And
flexibility.
he's smarter than me, so like it's a double.
And having access to those tools to move us from a conversation about blended capital and new tools to the reality of actually deploying those new tools to the benefit of the investments that are required. Do you see as someone who may have those tools, do you see a scale up in what is available to you from your customers, your LPs, your investors, to provide different kinds of capital that will help us scale in different ways? Or does Mark have it right? Everyone is in their lanes, and there's a limited amount of new tools coming on board.
I think if we stay in our silos, progress is going to continue to be super slow. I think we need to, it doesn't need to be that the same firm does it, but we need more coordination, more incentive structures. When we talk about blended finance, often it's sort of a emerging market theme, and it's often more of a development emerging market theme. I actually see blended finance as core more broadly, and you can define it in whatever way, but it's all of the plumbing system that you need for the transition. And I think in particularly agriculture, you need it. You can't just tell a farmer to do X, Y, Z. If their working capital loans 1 year, they're not going to make investments that are 3-year paybacks, particularly in soil health. And so you've got to marry practice and product with financing and risk management. I think that's critical. I think the other thing you have is, and I think there's a huge opportunity in lending and risk and innovating on that in a non-bank financial way, more specialty lending, specialty risk management. I think you've got to do that. The second is also infrastructure that will be needed, particularly with some of these new, there's the commodity system, and then there's sort of the non-commodity system, and to the extent that the niche non-commodity system is going to need new infrastructure. Both at the farm gate level, at the processing midstream level, and at the consumer level. And so that is not something that should belong in venture cost of capital, right? It should belong in more infrastructure cost of capital or next generation infrastructure capital. So I think we have to, like innovation finance singularly will not solve this issue. You've got to get other forms of capital and flavors of capital in there in order to finance it. And I think part of what I think is hindering the issue is like the nail in the hammer is innovation. And in order to unlock the issue on trust, on other things, it's going to be difficult. The final thing I will say, and it's not really our issue, but I think if you move to the speed of regulators, this is going to be even slower.
Earthrin, can I weigh in on?
Yes, you can. I was just going to say that last comment by Sanjeev was sobering, but true. And Agnes leaned into that same statement when she talked about the speed at which the capital from folks like the Gen, who generously invested significant amount, but at what pace? We're in 2023, and we're still talking about how do we scale to a 2030 goal. But Mark Watson, I'm sorry, please go ahead and
Yeah,
your space. Go ahead.
One of the opportunities for the private sector and to move this along is to change the lens for investors. So, for example, you may not be able to change the entire country, of India or all the US, but you can make place-based investing a lens in which you invite all sorts of capital and essentially serve as a market maker. And that is something that we do at Potluck. We invest in clusters in a place. We use grants, recoverable grants, low interest debt. We can deploy equity, subordinated capital, royalty financing, purchase order financing, grants, and I can go through other examples. But we're able to use all these tools to buttress a regenerative ag system in a place. And then market makes them by other players, some of whom hold capital that are on the screen, to insert themselves, including the government, to make that a reality. And I think that is one of the avenues where we can build models of how to engage the ecosystem, to Sanjeev's point, to play together with their respective constituencies and look at and measure the results in a place. So it's not so dispersed, so that other investors don't get confused around the interconnectivity of their investment opportunities. We're doing that in 8 states now. We have an equipment trust. One of the issues with smallholder farmers is you can't move toward regenerative ag if you can't handle the productivity issues. So we're building an off-balance sheet, philanthropically funded, at least initially, equipment trust, where they share in pods. Or agroforestry is a tough area for smallholder farmers to move into. It's a perfect vehicle to put in an SPV where you have recoverable grants to de-risk investment dollars. I mean, these are all different ways to use blended capital to invite other parts of the ecosystem to build resiliency.
So that speaks differently to what is possible than we heard from Mark and Sanjeev with bringing in different kinds of capital through one institution. You're definitely not in a silo, Mark. That is quite clear. But there's one point that I'd like to ask Agnes to comment on when you talk about using a different lens, particularly a different risk lens when deploying and identifying where to deploy capital and what capital is possible. The challenge that we often hear, particularly from commercial lenders, is the need to address the issue of risk. That while there is a commitment to blended capital to emerging markets, that the risk lens that you use still limits the ability that you have to invest in a broader scale of innovation outside of the traditional or what one would expect from a commercial lender. Does a new tool like or a tool which is not so new anymore, like blended capital or like the types of tools that Mark listed, do they provide you with any additional bandwidth to support that lens that you use as a commercial investor?
Yeah, in theory it does. I'm actually quite jealous on Mark's multiple of instruments, to be honest. That sounds really nice because you can all like tie them together. Of course, when we started off with blended finance, the whole theory was, of course, that when we use other de-risking parties, we can finance at a much higher risk. But between the theory and the practicalities, there's actually quite a big difference and a lot of modeling behind it and a lot of regulatory requirements as well. So yeah, we've managed to actually do a few things that were beyond our normal risk appetite statement, as we call it as a bank, but it goes very, very slowly. And that's also my concern. So once after two years, we saw, okay, there's a few models that work and a few models that don't really work. So for example, what we saw that worked well was in Brazil, the degraded land renovation. Right, there's lots of land there which is not productive, but to renovate it, you actually need a longer tenure. And then it's Brazil, so you also have something that's called the forest code. So a lot of farmers actually had reforestation requirements. So we said, okay, why don't we develop a program or a product basically that embeds both? There's a financing available for reforestation. It doesn't generate cash flow, right? So there's no repayment capabilities coming out of that, but we combine it with degraded land renovation that allows this farmer, if he uses the rotational grazing system, it allows him to implement more regenerative grazing systems. You also can have a few more heads per hectare in terms of cattle, which then allows you to repay the loan. But in order not to stressed the length or the repayment burden. We stretched the length of the loan. So we allowed him to have a 10-year loan. We standardized the loan and it has risk sharing in it. So that's what it is, a program that runs well because it actually addresses a real problem at the client. And it also has a tangible, measurable impact output. So it allows us to have a impact fund, in this case, AGI3, to participate there with their public money. That works. Smallholder farmer financing, super hard for a commercial bank. We've done one deal, and I keep getting questions asked about it and the modeling that we use behind it. We still try to reach and to do more of it, but it's much, much more harder. Yeah, so yeah, it has, we've seen both. But I'm a true believer in standardizing loans because that allows you to speed up the rollout of these funds and to maximize it. I think we're not a retail bank, for example, in the African space, but if I were one of the partner banks that we work with there, I would set up a similar program for a very sector specific focus to make these farmers more climate resilient. And just, you have to put in a lot of effort in the beginning, but after that, it's a standardized loan. So you can just push it out of your commercial bank system. Yeah, that's the skill we're looking for. Are you still on mute?
Agnes, you continue to return to this thing of it's slow. That as we talk about the change that is necessary, and the question of risk. Let's move over to the questions from our audience and Mark Khan, the question of risk and has been posed to you regarding the heat waves in India. And do you see this as a new normal? And how is that affecting the risk lens for the investments that you make? And connected to that is, what role do you see insurance in helping businesses deal with climate and other natural crises? And what are the main challenges to the scale up of insurance products to support the reduction of, if not the elimination of, risk?
Sure. So I do see the heat waves as the new normal. And it's not just the heat waves, right? It's also having an Indian monsoon that continues into October and November when it used to be done in September, right? We are looking at a world of just changing weather as opposed to just, whether it gets, just getting hotter, right? It's also getting more bizarre. We're getting rain at times where we are not prepared for it. And there's a ton of work that's going to have to be done to our agricultural system. Both, varieties of seeds that have, higher ability to withstand abiotic stress, higher ability to withstand drought, but also just changing our planting cycle, right? The entire conventional, Indian approach of the two seasons, the Kharif and the, which is our monsoon season, and the Rabi, is going for a bit of a toss, or at least changing on the edges, and will probably change more. And so there's a lot of work that has to be done to change this system. Does that impact us? Kind of, not really, is what I would say. Like, we back innovative businesses, and these sorts of changes create opportunities for them. I don't want to sound, too bloodthirsty and Wall Street about it, but the reality is, for innovators, these changes are opportunities. This is where disruption will come from. And where demand for new innovations for climate resilience will come from. So it is absolutely a huge challenge. It's also something where India continues to surprise. People thought this time last year, where India had the worst heat waves, it's hard to say in its history, but certainly one of the worst. And mortality was anticipated in the tens of thousands, and I think like 100 people died. And there were articles in the New York Times like, what happened? And it wasn't the case of the government fudging numbers. It was the case of a system that is built for resiliency. The reality of the Indian system, and it's true in minority communities in my own home state of Texas, is there is more resiliency baked in than a lot of fancy or more fragile systems out there. And so I have hope that between that inherent resilience, and let's not always assume that it's unlimited, and the work of innovators like the ones we back, that things will be able to work out. And certainly insurance plays a role in that. We have backed historically a few insurance-related businesses, notably a very large insurance brokerage in India, and we're likely to do at least 1 or 2 new insurance-related investments in the next year or two. In fact, I was meeting a brand new crop insurance startup last week in Delhi. So this is top of mind for me, and certainly where we'll be investing.
Mhm, mhm. So before I go to the next question, I want to go to you, Sanjeev, because you're famous for saying that S2G invests from farm to fork, and you're agnostic about where. Are you investing in new insurance tools or vehicles that could address some of the challenges that were just alluded to by Mark?
Yeah, I mean, as agriculture goes from data poor to one day data rich, I think there's a huge opportunity to take that data, and assuming you have distribution like Mark's brokerage as example, unique data, unique distribution will allow you to come up with innovative financial products. I think in the OECD countries, you've had sort of a structural credit enhancement and multi-peril crop insurance. That provides a bit of a floor. I mean, there's a similar scheme in the EU, but different. I think that's not going to be sufficient. You're going to need much more creativity, much more, and married with lending as well, particularly longer duration lending. If we are serious about funding these farmers, we have a farmland fund we started, and we do 7-year leases as opposed to a 1-year lease. And because you can't make the changes that you want if you have a 1-year lease. So I think duration lending, unique risk is a huge opportunity. And frankly, I'm curious if Agnes will react to it, it can't be in the traditional banking system or the traditional regulated insurance system. It's got to be sitting outside of it. And we need to allow that innovation to continue, because bank regulators increasingly are going to be focused on risk, or insurance regulators. And so we need to make sure that as these products get developed, that we have the proper level of oversight and almost create a non-bank financial system, because that's going to lead to faster cycle. If it's heavily regulated, it's not going to be innovative.
Mm-hmm. Mm-hmm. So Agnes, he challenged you. Do you see?
No, that's a fine. That's but we see the same, eh? We see the same within the bank, because it's so. To put it bluntly, if it doesn't fit in the box, we can't do it, right? Because there's just too many risks from a bank and your regulator relationship. So it doesn't work. So you have to have, say, separate vehicles. Actually, outside, you can still be involved as a bank. You can invest in a vehicle like that. We did it, for example, because I also liked Sanjeev's remark that blended finance is not just for emerging markets. It's also very much for, say, non just European markets or the US. There's lots of transitions to be financed that are more difficult, because a lot of the transitions actually are including something that's beneficial for the public, not necessarily for the cash flow or the profitability of that entity. In the longer run it is, but initially, like in the Netherlands, we have a huge nitrogen crisis. I mean, that will need all the public, private combined funding that we can bring in. But I wanted to say, for example, in Ireland, we did a transaction where we actually set up a vehicle where multiple funders came in, ourselves included, and we really allowed Irish farmers to invest in additional productivity at the time. This was when the market, when the milk price was released in the European Union, and Ireland was the best place to be productive, to increase its productivity. And there you can see that these vehicles are just much more easier in terms of, okay, how do you make quick assessments of these clients? How can you link between the milk check that comes in and the repayment of the loan? It's just easier. But as soon as you want to have, say, a vehicle that serves in multiple jurisdictions, it's a bit harder, right? Then you do run into all kinds of things. But yeah, I agree. I have to say, I agree with Sanjeev. In order to be more innovative, more quicker, outside of the normal commercial debt, banks, basically, it's probably easier. And we're tapping into that a bit as well. We also do some equity investments as partnerships into banks usually, but now we've done the first investment into an Indian NBFC. So we're also testing whether that that is really true, right? Whether they are easier and quicker to adjust into these innovative approaches. Yeah.
So Agnes, as you talk about the challenges of different places in deploying capital, I'd like to invite all of our participants today to join for the second part of the private sector dialogue, which is a working dialogue on the development of the co-investment platform that will take place on April 27th at 1600 to 1700 CEST, that talks about how do we align capital at the local level in different jurisdictions to make a difference. But let's go back out to the questions from our our participants. And I want to start with you, Mark Watson. There's a question that says there seems to be a lot of capital available, but the problem is accessing it or knowing who is offering what or who wants to invest and therefore making their services available. Could governments lead on this? Again, this I'm assuming is providing better access to and information about access to capital, but and the governments lead by creating the mechanism for private investors to engage in, or like a national investment platform on the agri-food systems, which pools resources from commercial lenders. Doesn't have to lend or be managed by governments, but that it could make the information available by governments. Is this happening anywhere that you're aware of? And if not, do you see this as a viable opportunity? And how should private sector work together to support making that potential opportunity a reality?
I can speak to the US. I think this is critical. We just talked about risk. We talked about alternative capital providers to move this along. And one of the challenges I see, one way to manage risk is to spread it out. So you need secondary markets and access to that in order to do that. And so I think there's a role, particularly in the US, and we're together with others pushing for this, to provide alternative lenders with access to some of the risk mitigation or credit enhancement tools to be able to sell our originated deals, blended capital deals, to pension funds, endowment funds, global players. The more that we are able to splice and dice the risk that we're originating, the more that we can track more capital and it can fit in other portfolios. I'll give a notable fact. I know we're closing up on time, but one of the surprising factoids that I learned is that the Farm Service Agency's portfolio in the US, which has both guaranteed and direct loans, has there's an operating loan and there's land ownership loans. But the write-off, the bad debt, is less than 1% for $17 billion worth of debt. The default, which is missed payments for operating loans, is 4%. Those numbers obviously are enhanced through insurance and things we just talked about, but that gives you some indication, and this is the lender of last resort in the US. So I would argue those numbers are great if you compare that to small business lending and other types of investments that we all make. But there's an opportunity for us to apportion credit enhancements, clearinghouse access, partnerships between regulated and unregulated entities, so that we can move this along. So I think there's a huge opportunity. We're pushing for that.
And Mark, you're absolutely right that there are some opportunities out there that I'm hopeful that as we continue to move forward, those opportunities will become more prevalent, not just in the United States, but in other places that can help us scale up and move faster, as Agnes keeps reminding us. And we are closing in on the end of our conversation, and we have a couple of other questions in the chat. But what I'd like to do before we close is to go to each one of you, starting with you, Markan, and ask you in 1 or 2 lines to, as you are coming out of this conversation, if we are going to make multi-sectoral investments in the food systems transformation more of a reality, but that we're scaling it up, that we're moving faster, particularly when we're talking specifically about private sector. What are the suggestions that you would offer to the advocates in this space that we need to ensure that we are embracing and moving forward to make as Agnes said, move from theory to reality?
We either need to get the various actors from the equity side, both early in growth, from the debt side, and from the, I would say, structured instrument side to coordinate more closely, or we need to come together and build institutions that have this more diverse set of offerings from the get-go. That operating in our respective silos are optimizing for ourselves instead of for the system as a whole. And we need to start moving in that direction, which is hard to do, right? It's when you're an early stage VC, you don't do debt. When you're a late stage mezz debt writer, you don't understand early stage risk. So the question is, how do you get, since you need all of these instruments to be in sync, how do we make that happen? And I think that's sort of the need of the hour. So
Sanjeev, back over to you. And Mark's posed a question that I know you've been trying to grapple with. And what do you see as the way forward to really scale up private sector capital in the food systems transformation?
I guess I'd call it in 3 buckets. One, that it's one transition, not 3 or 4 transitions. We need to be part of that flow of capital. The food system has a unique potential to play, similar to the way forestry played maybe 10, 15 years ago. So the language we use, the complexity we define things, if it's too complex, it's not going to be attracting capital. 2, I think we need to see more, more coordination, to sort of Mark's point, with also government. I think that is going to be critical. Like the energy industry got production tax credits. They got things like priority dispatch. Where is that in the food system? I would argue we're as important, if not more, than the energy systems. And there is no sort of that same incentive structure to push the system. So I think that's going to be important. And then finally, we are going to need scale. We are going to need liquidity. We do need to, like, this is still a small. We are a small niche within global capitalism, and we are going to need more people to make money with these investments, more exits, et cetera, in order to attract more capital.
So, Agnes, over to you. What do you see coming out of this as we close in on the end of our conversation?
Yeah. So thanks very much, both Mark and Sanjeev. I think the bridging or the connecting or making sure we get to know each other is key, not just between the different type of lenders, but also between the governments and the commercial or the private sector side. And then specifically from an emerging market point of view, where you have a lot of donors' money available, but they all come with different impact requirements. So where I said in the beginning, I'm a great fan of standardization. I'm also a great fan when it comes to reporting on impact, standardize it. Because if you don't standardize it, and I know that's hard in the agricultural sector, but if we don't go for a number of standardized approaches, everybody will try to find this one tiny product or tiny project that fits all the boxes, but then it stays with that one tiny thing. Then we never get scale, right? So that.
So get into scale. Mark Watson, you get the last word. You've given us a lot of ideas today about what is possible. If there's one additional suggestion that we need as a community of private sector investors to scale up and move faster, where would you leave us today?
It's a word of caution. We ended up in this situation because we were only operating with the top 20%, funding the top 20% of businesses and infrastructure and capital equipment companies. We need to work at both ends so that you build resiliency. You need small, as we have learned through the pandemic, to buttress the large. So whatever solutions we develop need to work at both ends of the spectrum. That would be my caution.
Well, we've talked about the solutions, and the one thing that comes through on all of these, whether we're talking about working at the top of the system or with those in the smaller and lower end of the system, that we need to work together, that we need to begin to build the relationships that are necessary for us to deploy the capital with more transparency to the, not just to asset managers and owners, those clients, those LPs, but also to the businesses that we support out there, and that we need government. We need government support and we need government partnership. So I'm looking forward to working with all of you as we continue to build on this conversation, as we move towards COP28. The next conversation is at Aim for Climate coming up in a couple of weeks. And I know Sanjeev's having a conversation with the S2G, and then on to the stock taking at in Rome in July. But we must continue to have private sector engaged in this conversation, not just in what we need to do, but talking about how we deploy capital differently and committing to catalyzing that capital. With that, I thank you all for your participation. I thank our audience for staying with us, and I look forward to continuing to engage with each of you. Goodbye, everyone.
Thanks, everyone. Thanks for having us.
Bye.
Thank you.